Good morning. Welcome back to Professional Insights, brought to you in part by the National Referral Network. We've got a phenomenal conversation this morning. We've got Stewart Guthrie from the Liberty Group of Nevada with us. Good morning, Stewart.
Good morning, Mike.
Stewart is a business broker. I think it's imperative for business owners to understand what their options are when it comes to an exit planning. There's a lot of stages in that. We're going to get into some of those. But just to get things going, Stewart, you and I have had this conversation before. What does a business broker do for business owners?
I'll give you my tagline. We help people buy, build, and sell great businesses. If in order to be, at least in California and Nevada, you have to be a real estate agent to be a business broker. I am a business brokerage savant. All I do is handle the business side. I typically bring a real estate agent to handle if there's real estate involved. But we typically, the process is to do an evaluation of the business to come up with an appropriate business value, which I think we're probably going to get into in terms of that's a very, very important thing. To get a realistic view of what the value of the business is, and then we market the business and introduce buyers and sellers, and hopefully we can make a deal happen so someone can exit their business gracefully with enough money to retire on, and a new person can live their entrepreneurial dream.
So, Stewart, look, people sell homes by themselves, right?
Mm-hmm.
And I know there's representation. You want somebody representing you. Why does a business owner want somebody representing them in the sale of their business?
Short answer would be the complexity of the transaction. In other words, a residential real estate transactions, for instance, there's probably 4 or 5 orders of magnitude more transactions in that industry. Specifically, I'm talking about residential real estate, than there are business transactions. When a process has been so beat up and hammered and been so defined, it's become, and I'm not being critical of it. It's fantastic that it's such a well-refined, well-defined process. There's regulatory restrictions around how these interactions take place, and it becomes kind of a kabuki dance, if you will. In other words, everyone knows the steps depending on your market. Everyone, both sides, buyer and seller, use the same forms in the transaction. There's a very rigid set of very rigid structure. That doesn't mean that it has to be that way, but it is. And like most things, a market develops because of the number of people participating in it. There's a lot of people participating in that market. Everyone has to have a place to live. The business brokerage side is that I would say that every part of the contract is a negotiation. Every piece of it is a negotiation. The beauty is in the eye of the beholder. There's different types of buyers. I've often said that the best way to liken a business transaction to a real estate transaction is to look at it as if you were selling nothing but rental properties. In other words, the reason you buy a rental property is for the return on your investment.
Yeah.
That's the only thing, or should be the only thing, that drives a business transaction.
Now, there's a lot of
question.
Yeah. So there's a lot of steps in that, Stewart, right? There's
a lot. Yes.
If every aspect, or not every, but if a lot of the aspects of a sale of the business are negotiable, then what steps should a business owner take to prepare to get that maximum value to kind of help ensure a smoother process?
Recognize the fact, first off, that there's going to come a time when you are not going to be running your business. That is, and here's the thing, that doesn't mean you have to sell it. I want to sell their business for you. I want to sell everyone's business, right? But the fact is that not every business is going to be sold. In some cases, you're going to turn it over to your kids. I would advise you have a heart-to-heart conversation with your kids about that, because my wife and I owned a property management company, and we thought, we're going to build this legacy. We're going to have this big property management company. They're going to take it over. They looked at how much we worked, and they looked at I've got 3 kids, and they looked at how much we worked, and they looked at, the interactions that we had in our case, a very tenant friendly state in California at the time. And they essentially said, there's no way in hell we're doing that business. I'm not going to do that.
They just
And
waved it
so,
off. They're just
and
like,
they
nope.
just, nope, we don't want to. We don't want to. Like what we were talking earlier, I have one son who'd rather roll around the dirt in the Marine Corps than, be in the property management business. So,
That's fair.
yeah.
So, Stewart, you mentioned at the beginning this term valuation.
Mm-hmm.
And the interesting thing, coming from the investment banking side a long, long time ago, and watching Shark Tank, right? They do a very, very simple mathematical formula for valuation, but there are lots of ways to do valuation. I don't want to get into all of those, but what are the key factors that influence the valuation of the business? And then how does that help ensure that the business is priced right?
So businesses, first off, the value of a business as it relates, as a ratio to the profitability, changes with the size of the business. So in other words, a Main Street business, with mom and pop, there's all sorts of ways to refer to it. In other words, your typical small business, and I think most people would be comfortable defining a small business as anything with $10 million of revenue and below, top line revenue. But that valuation, so pardon me, that valuation is going to, I apologize. There we go. That valuation is going to vary based on the size on the size of the business. So it's going to go up in value, just by virtue of it being a larger business. In other words, it's the valuation, the business valuation is kind of a measure of risk, and the lower the risk of the business, the higher the multiple is going to be. But in terms of like the most valuable parts of it, very first thing is the business profitable, and that is a kind of a cut and dried thing in terms of how you on how you treat your business moving forward. In other words, most people, if they're running in the middle of running their business, they're taking a lot of risk as a business owner versus working for somebody else. And so many people tend to be very aggressive in running personal expenses to the business whenever they can.
Yep.
And that's fine. I think that business owners can probably make better choices about how to spend their money than the government can. But when it comes to the time to do evaluation of the business, now all those personal expenses that run through the business, it's hard to really attribute those objectively to the productivity of the business. So that's a long way to say between 3 and 5 years before you're ready to sell your business, start paying some taxes, right? In other words, start reporting your income as opposed to running everything you can through the business, because it's the kind of the gold standard in valuation is what are you reporting on your tax returns? If you're reporting a loss, and then I go through the process, we call it recasting, right? So in other words, I go back and I have an interview. I remind people that I'm not an IRS agent. And so if you are running personal expenses through, we're going to try to pull those back in. But unfortunately, formal financing sources with SBA lenders or something like that, have got to look at those. And in some cases, they will count those deductions, those things that you ran through your business. In some cases, they won't. And then they make a decision based on the cash flow. Will the adjusted cash flow that they can count, will that support the value of the loan? Yes or no?
So you mentioned that 2 things in there, Stewart, that are common pitfalls for business owners. One, although you didn't say it exactly, their books aren't always in order.
Mm-hmm.
So, that's one thing. And then one of the key things that you mentioned is that 3 to 4 years. And despite a lot of the documentation and articles that businesses should plan 3, 4, 5 years in advance, they tend to call you the week before they need to sell. What are some of the things that you could share to try to help create that paradigm shift as to the importance of getting that 3, 4, 5 years in advance?
Here's ultimately what it comes down to is the fact that all the things that make a business more saleable, profitability, the fact that the owner is not the hub of the wheel. In other words, it may feed a business owner's ego to know that every decision crosses their desk and they make every decision on their own. That is not an attractive business to buy. Have you built your business? Have you built out your business to the point where you can hire people and you can take a vacation? Kiyosaki's definition of a business owner versus being self-employed. If you can leave your business for a month and come back and it's bigger than it was when you left, you're a business owner now. Up until then, you're self-employed. And there's nothing wrong with being self-employed, but understand that you've got to engage a financial planner and make sure that you put away your money correctly, because if you are the only employee in your business, there's not a lot to sell at the end of it. In other words, and I think that unfortunately that's what a lot of business owners, they have this idea that, it's all, for whatever reason, it's all, my business is worth about $1 million. It's kind of where it hangs, right? That's what people are thinking. You do a real valuation to find out it's worth $350,000 or $400,000. That might be a shock to your financial planner, or probably not. The financial planner's been down this road before. He's had that conversation. But people need to have a realistic view of what they can get for their business. And then if they make those adjustments to make their business saleable, here's the other thing. The business is better anyway. Maybe you make those adjustments 5 years before you leave, and now you can take a month off or 2 months off, or you have a manager. I mean, you're going to have to grow your business in order to be able to pay for those personnel, and you're going to have to get good at hiring people, which in many cases is not attractive. People don't like the idea of it, but a business typically has employees because you want the business to be able to run on its own while you're not there.
Yeah. And that is a hard part. And one of the things that I've learned from you over our relationship, Stewart, is the difference between real estate and business. Selling a business is real estate is public, right? Yes. Selling a business is not public. So there's confidential. Yes. There's confidential concerns, confidentiality. There's certain things that can be disclosed and cannot be disclosed. Go into those real quick, because I don't think a lot of people, like, you just can't put a for sale by owner in the front of the building and just advertise it on a paper, right? So kind of go through that confidentiality side. Sometimes people do, right? I mean, and it kind of depends. I mean, here's the thing: in really small towns, and I grew up in a really small town. If the mercantile is going up for sale, maybe they will put a sign in the front window, and the person working at the mercantile, because there's a limited number of jobs in that town, they're going to keep working at the mercantile until a new owner comes in, and chances are it's going to be someone else in town who buys it, right? Yep. But for the most part, when we're in a city, whether it's a Reno or a Sacramento or something like that, especially in the current job market, you don't want your employees to know that you're selling, because you don't want them to suddenly start considering that offer that they were getting, because they're being headhunted. Yeah. You don't want them to start thinking, well, maybe now's the time to move on. I mean, we'll hear it from buyers all the time. Well, what's the guarantee that these employees are going to stay? There is none. There is no guarantee they're going to stay. However, if they like the work that they're doing and you don't come in and tear things apart, why wouldn't they stay? Right? That's the other part of it. But that's, this is all part of it's part of the negotiation. It's part of the process. But the key is, we don't want the word to get out to the employees, the competitors, the customers, that the business is selling, because invariably, the word that goes, hey, did you hear so-and-so is shutting down? They're not shutting down. They've got their business on the market, but somehow or another that gets interpreted that they're closing the doors and, I need to find another vendor, or I need to find another
job, right?
Yeah.
So confidentiality is huge in our industry.
And Stuart, there's a lot to this, obviously, right? And we could take one of these questions and dive into a whole separate conversation.
Oh, I could bore you for hours on any one of these.
And,
yeah.
And I'd love to do that. But obviously I want to be cognizant of
That's
your time.
It's very kind of you to say that, Mike.
Yeah, I want to be cognizant of your time. But there's a lot of aspects of this. How important is it for you to have a team? Because, I mean, you mentioned taxes, you mentioned obviously the confidentiality side, there's structuring, there's employee stuff. How important is it for you to have a team of professionals that you can pull from to help these different aspects of the business?
It's immensely important, because the fact is that most businesses are started by technicians, right? Most businesses are started by people who know how to deliver the product, good, or service. And it is critically important that you have people that specialize, right? In other words, that the Industrial Revolution came about because of division of labor. In other words, find someone who can specialize and do what they do. I am not a CPA. I think I have a fair understanding of financial statements and things like that. But
Yeah.
if you have a CPA that is there, that first off, during your first years, before you're thinking about selling, that is, trying to optimize your business for tax purposes, and then the latter part of the years, optimizing your business to make it look as good as possible and run as much business through you, to show as much profit as you can. You need to have someone who can make those adjustments. The books need to be in order. They need to be clean. And depending on how big your business is and who the buyers are, they may want to have audited financials.
Yeah.
You want to have someone who already understands and knows your business. CPAs are magical. The same thing with attorneys, frankly, the stuff I'm talking about casually, you need to have your, you need to have your business lined up. You need to have a business plan. You need to have, you need to know how to how to hire. That's coaching. I mean, I'm casually saying that stuff, but the fact is, you need to have someone, these business owners need to have someone who's good at this stuff. And if if you have a big enough business that you have someone hired in-house to do that, or you go hire someone outside to come in and basically be that consultant, that fractional, HR person to help you make good hiring decisions. It is critical to have these things, especially as the business goes up in size.
Yeah, no, it's a very intricate, detailed process. But Stuart, I want to thank you for everything that you do for us and our partners and our clients. Thank you for being here this morning. If you guys have any questions that you're watching this, whether it's on live or YouTube or whatever the case, drop the questions in the comments below. One of us will get the questions to Stuart. We'll get you guys in contact. Make sure you subscribe to the channel for more professional insights. We are here for the most part every Tuesday morning. But other than that, Stuart, thank you so much for the time. We really appreciate it.
You bet, Mike. Appreciate it.